Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Park Aerospace Corp. Quarterly report. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Park Aerospace Corp. Offers a diverse range of businesses and services that cater to the aerospace industry. The company develops and manufactures advanced composite materials, including film adhesives and lightning strike protection materials, which are used to produce primary and secondary structures for various aircraft types. These materials are designed for use in jet engines, large and regional transport aircraft, military aircraft, unmanned aerial vehicles, business jets, general aviation aircraft, and rotary wing aircraft. In addition to composite materials, the company also provides specialty ablative materials for rocket motors and nozzles, as well as specially designed materials for radome applications. Furthermore, Park Aerospace Corp. Offers design and fabrication services for composite parts, structures, and assemblies, including low-volume tooling. This comprehensive range of products and services enables the company to meet the complex needs of the aerospace industry in North America, Asia, and Europe. Park Aerospace Corp's stock price has increased significantly in the past year due to a series of positive financial results and strategic developments. The company reported strong fiscal year 2026 performance, with net sales increasing by over 20% and gross margin improving to 34.1%. Quarterly net earnings nearly doubled, and basic earnings per share rose to $0.15 from $0.08. Park Aerospace's strategic growth initiatives have also contributed to its stock price increase. The company announced plans for a $50 million investment to double its manufacturing capacity, signaling optimism for future growth. Additionally, Park Aerospace highlighted strong demand for its aerospace and missile systems materials, emphasizing its critical role in these programs. The company's financial health is another factor that has driven up its stock price. With zero long-term debt and a robust cash position of $63.6 million at the end of Q3 FY 2026, Park Aerospace Corp. Maintains a strong balance sheet. Its Altman Z-score of 27.91 and Piotrowski F-score of 8 indicate a very healthy financial situation. Overall, Park Aerospace Corp's combination of strong financial results, strategic growth initiatives, and robust financial health has driven its stock price increase by over 68% in the past year. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the positive side, robust commercial and military equipment programs have contributed significantly to revenue growth. Higher sales volumes, increased selling prices, and more favorable product mixes have also played a crucial role in driving revenue upwards. Furthermore, the company has experienced growth in sales to emerging markets such as space, commercial, and military sectors. Favorable sales mix and lower labor costs and overhead costs have also contributed to the increase in revenue. On the other hand, the decline in revenue can be attributed to storm-related delays that resulted in a significant loss of sales. Additionally, the company has faced challenges in the business aircraft market, leading to a decline in sales. These factors highlight the importance of managing various aspects of the business to achieve growth and mitigate potential losses. Net income experienced significant growth over the specified periods. For the 13-week period, net income increased by 86.7%, while for the 39-week period, it rose by 60.4%. These increases were consistent across different reports, with another report showing an 87% increase in net income for the 13-week period and a 60% rise for the 39-week period. The growth in profit margins was even more pronounced. The gross profit margin increased from 26.6% to 34.1% over the 13-week period, indicating a substantial improvement in profitability. Similarly, for the 39-week period, the gross profit margin rose from 28.1% to 32%. These increases suggest that the company's ability to generate profits has improved significantly. The reasons behind these changes are not explicitly stated in the provided summaries. However, it is mentioned on page 24 that higher earnings and improved collections of accounts receivable contributed to the growth. Additionally, a payment of $1.6 million for a long-term supplier advance partially offset some of this growth during the 39-week period, ended November 30, 2025. The company's financial performance indicates a healthy trend in its operating cash flow. According to the data, the company has successfully generated a significant amount of positive operating cash flow, totaling $4.6 million. This is a clear indication that the company is managing its finances effectively and is not struggling with liquidity issues or negative cash flows. The absence of any mention of such concerns further reinforces this conclusion, suggesting that the company's financial position is stable and secure. The company has demonstrated a commitment to returning value to its shareholders through two key initiatives. Firstly, it has paid dividends, providing a direct return on investment for shareholders. In the recent 39-week period, this equated to $7.5 million. In addition to paying dividends, the company has also engaged in share buybacks, another common practice used by companies to boost shareholder value. During the same 39-week period, it spent $2.2 million on buying back shares. There are growing concerns about the stability of our supply chain. One major concern is the potential for disruption due to storm damage at our facility in Newton, Kansas. This could lead to a shortage of critical materials and impact our ability to meet customer demand. In addition to this physical threat, we also face economic challenges that can affect our supply chain. Inflation is causing prices to rise, making it more expensive to obtain the raw materials and supplies needed for production. Furthermore, issues with other suppliers are affecting customers' production, creating a ripple effect throughout the entire supply chain. Another potential disruption comes from Ariane Group's manufacturing equipment upgrade, which has been funded by Park. While this investment is intended to improve efficiency and quality, it may also disrupt the supply of RAYCARB Seatwo BNG, a critical component in our products. This could have significant consequences for our customers and our business as a whole. Overall, these concerns highlight the need for careful planning and contingency measures to mitigate potential disruptions and ensure the continued flow of goods and services. That concludes the financial summary for Park Aerospace Corp. Feel free to comment below, and I will be happy to answer them when possible.